As someone said earlier, compliance is a quite expensive hobby, and it can either make or it can break your business. So today we're going to talk about why it can break your business and what are the main challenges today when it comes to financial crime compliance, and what you can do as VASPs or as banks in order to manage to mitigate those risks and to achieve greater efficiency and effectiveness. So I would like to start by doing a little bit of myth busting. There is a common misconception in the industry that crypto is mostly used for illicit activity. And if we go back in time, in the early days of crypto adoption, maybe that was true in a way. And at Elliptic, we are monitoring over 150 different digital assets. And what we have observed is that in the early days, around 30% of all transactions involved some sort of illicit activity. So we would see funds coming from dark markets, dark forums, cyber attacks, and so on. But moving today, this number has dropped to below 0.5%. And that's mainly for two reasons. First is regulation. If we go back in 2015, we can see that it was more or less the Wild West. We had the US, where they start building a regulatory framework around crypto, but everywhere else in the world, they were not looking from a regulatory point of view. But if we look today, in most major financial centers, we can see that we have quite robust frameworks. So you can see some countries in green. Those are countries that have robust guidelines and regulatory frameworks. They have adopted the FATF guidelines. And basically, they allow crypto transactions, but they subject virtual asset service providers to the same requirements as any other financial institution in the region, plus some more. Then we have a few countries in orange where we have some activity that is allowed and some activity is not allowed, and they are in the process of building their framework, but they don't necessarily have a very robust framework yet. And finally, we have some countries in red which have banned crypto, or they're thinking of banning crypto. But the main point is that the regulatory landscape around crypto is not the Wild West anymore. We have good guidelines. We have a lot of robust regulatory frameworks. Switzerland is a great example. And more countries are building their frameworks. So we have the confidence now in the industry that we can operate and we can innovate within crypto, but of course we need to always take into account the regulation. And the second reason the ecosystem has become more fair and safe is because we have blockchain analytics, like what we offer at Elliptic and what some of our friendly competitors offer in the industry. So basically, for those of you who are not familiar with blockchain analytics, as Marcus was explaining earlier, if you are a VASP or a bank and you are accepting or facilitating crypto transactions, then you need to be able to identify the ultimate source and destination of those funds. And you need to make sure that your counterparties and your customers are not transacting with counterparties that are dark markets, any illicit entities basically, or any sanctioned entities. So I would say these are the two main drivers today that are making the ecosystem more fair, more safe, and allow for adoption and for growth. However, there are a couple of main challenges that we will be facing going forward. And those challenges are around effectiveness in terms of how we do compliance and efficiency. And I will explain what I mean by that. So if we look at the ecosystem, it's becoming more and more complex. We see new use cases, we have DeFi, we have more participants entering the space. So overall, the complexity in the ecosystem is continuously increasing, and it's really important for your compliance function to be able to identify any activity that can be associated to money laundering, sanctions, evasions, fraud activity, and so on. Also, we see that cyber criminals becoming more and more sophisticated. And because the ecosystem is becoming more complex, they are devising much more sophisticated strategies in order to layer their funds. And by layering funds, we mean obfuscating the source or the destination. And finally, we have multi-layer monitoring. So if you look in the fiat world, and let's say you're a bank and you receive a transaction, that transaction is coming from one hop away. So you know who your counterparty is by default. You don't have to go through complex networks of transactions, assess what's your exposure to X entity versus Y entity, and so on. But in crypto, a transaction may be coming from 100 hops away. The funds may be combined across the way. So basically, you have to do monitoring on the blockchain and see if that transaction appears to, let's say, involve any money laundering activity, if the person who is sending the funds is trying to structure the funds through different paths and so on. But then, once you receive the funds, you have to monitor your customer holistically at the exchange level. You have to look at the customer's transactions across a period of time, a week, a month, a year, and see if there is any unusual activity. For example, are they receiving multiple transactions under the reporting threshold? Do they combine those transactions and then rapidly send the funds into a high-risk jurisdiction or convert it into fiat? So these are the kind of typologies you have to monitor, and you have to monitor those within an exchange or within a bank, but also now, because you have this level of transparency on the blockchain, you have to also monitor the blockchain. So in terms of effectiveness, what I mean is be able to identify any potential money laundering activity. And with the cryptocurrency transactions, that is increasingly becoming more and more difficult. So that's on the effectiveness side. Let's have a look at the efficiency side. So if you're a VASP, a custodian, an exchange, a custodian, or a bank, and you're familiar with compliance operations, you may know that within AML operations, depending on the size of the organization and the size of your customer base, you may have from tens to thousands of AML analysts investigating alerts. And that comes at an extremely huge cost. And as we have seen over the past few years, and probably we're going to 10 people within your AML operations. And this is over the next 2 years. This line shows you how potentially your alerts may increase over time. Now, your main problem is that with your existing number of employees, you will not be able to investigate those alerts. So you will need more people. Now, one thing we see sometimes in the industry, both in the crypto industry as well as the traditional financial services, is that some will say, well, I have 10 people, I'll change my systems so I get enough alerts for those 10 people. That's going to cost you a lot. It's called alert suppression, and probably it's going to set you back several millions of dollars in fines. Your other option is to try become more efficient and more effective, do all sorts of initiatives. I spent most of my career working for very large banks and trying to increase their operational efficiency within AML investigations. We would, for example, change the way they take screenshots, bring a new system that will save them 5 seconds in the process, and they would save 500 FTEs. But those initiatives don't always work, but definitely they will drop that line further down, so you might need less people. But I guess the main point from this graph is efficiency, and measuring that efficiency is really key. It's going to be a problem as transaction volumes grow. You can be smart about launching initiatives today in order for you to become more efficient, but you also need to start thinking about hiring more people, because at the moment it's quite hard to find good talent in the industry. So what can you do so that crypto can make your business, compliance can make your business and not break it? I think the first point is to think about your target operating model and how you're going to change that operating model and what sort of technologies you're going to bring in. But it's not just about technologies, it's also about processes and it's about people. So when we think about processes, everything starts from whatever solution you have there that generates your alerts. You have to be careful how you go about calibrating those solutions, how you build your scenarios that detect money laundering or any other kind of illicit activity. And you need advanced analytics in order to be able to assess those scenarios, to fine-tune them, things like above, below the line testing, and so on, to make sure that you're not getting too many false positives that will overwhelm your operations. And of course, you need quality assurance. Like, you generate a bunch of alerts, your operations will investigate them, but are they doing the right job? Are they catching the bad guys? And how do they take that feedback and they send it back to your alert generation so that you can fine-tune it further and make sure you don't get those false positive alerts again? And then if we look from efficiency point of view, how do you optimize your investigations? How do you change the process? How do you provide clarity to your analysts in order for them to be able to do their work more efficiently, faster? How, for example, you take care of data and of your customers. One of the big problems in the industry when it comes to compliance is customer experience, because very often when an analyst takes a case and they start investigating, they realize that half of the KYC profile for that customer has been updated 10 years ago. So they will start reaching out to the customer, and the customers are not happy when they receive calls asking them about their passports or why they did this transaction or where the funds have come from. And finally, how do you collect data? How do you update the KYC profiles? How do you learn more about your customers? How do you learn more about their transactions? How do you take structured data and you feed that into all the other systems you use within compliance? So that's about process. And when it comes to technology, again, there are so many different components. I'm just going to show you a few here. Blockchain analytics is one, but it's not the alpha and omega when it comes to financial crime compliance within the crypto industry. Blockchain analytics is a component that is necessary because by default, on the blockchain, you don't have information about your counterparty. So with blockchain analytics, you can get that information, and you will know if the funds have come from a dark marketplace or they have come from a legit exchange. But you also need to have additional systems like your transaction monitoring systems, your payment screening solutions, your case management solutions, and so on. Of course, you can use more modern technology like machine learning. You can use artificial intelligence, become more effective in the way you identify those financial crime typologies. It's still early stages, but over the past decade, I have seen those solutions work better and better every year. So I would definitely recommend looking into something like that. And then from an efficiency point of view, once you get your thousands of alerts about money laundering, what other tools you can use in order to increase the efficiency with which you do the investigation? You can use natural language processing and generation in order to speed up the investigation or to read quickly through documents about the customer or negative news and so on. You can use robotics process automation in order to remove mundane tasks like having an analyst go through different systems and portals and pull information about the customer. And you can use things like behavioral analytics to make sure that you avoid any account takeovers, and you can be certain that whoever is transacting and sending those 10 bitcoins out of your VASP is actually your customer and not a hacker. And finally, people, which I think it's probably the most important element within compliance. When it comes to people, of course, you need to have a robust compliance culture within your organization. And the best way to do that is by having a robust policy. Know what right is and reflect it within your policy. Define your risk appetite statements and make sure that every person in the organization, whether they work within compliance or outside of compliance, they are very clear in terms of your risk appetite and your mission and why compliance matters throughout the organization. And finally, take those policies and convert them into procedures, standard operating procedures for personnel within AML operations, so that they know what they are expected to do. They have an idea in terms of step by step, that's the process, that's how I need to do it. Consistency is important. When you lack consistency within operations, then it's like opening the compliance Pandora's box. And finally, to increase your efficiency, of course, you need the right people with the right skills. You have to identify those gaps within your organization. So you need to have a good idea of what your organizational model within compliance looks like and what are your gaps at the moment, and go out finding those people. But when you find those people, it's important to make sure you retain them and you help them to constantly grow. Compliance is ever evolving. The crypto landscape is constantly changing. I'm new in the industry. I've only been for a year and a half. And I think it's impossible to get bored. If you get bored of crypto, you're kind of bored of life. So make sure that you constantly invest in terms of upskilling those people and helping them understand not just the crypto side, but also the traditional compliance side. Thank you.
Thank you so much, Selios. Yes, I agree. Compliance is a pain point for a lot of companies.
Just 1 second. Can you just go back to the slide with the number of bitcoins involved in criminal activities?
Sorry, number of?
Slide with the bitcoins involved in criminal activities. You have that at the beginning of the presentation.
This one.
It's just so nice.
Thank you.
Lovely. Do you want to do questions? Or
Yeah, absolutely. If there are any
Anybody has
questions,
any?
happy to answer. Yeah.
How do you know these numbers? How do we happen to know the numbers? How do we know what's happening?
Yeah, so basically, this is our bread and butter at Elliptic. That's what we do. We monitor all transactions on the blockchain, and we identify those transactions that are coming from illicit entities or high-risk entities. And that's the whole idea behind blockchain analytics, to identify, for example, a transaction is coming from a legit exchange or from the Silk Road. Maybe it's more. Yeah, absolutely. I'm not saying that, this is the Bible chart. Yes, please.
If you believe this chart, it means for every third Bitcoin that is circulating today, you can have, if you go back in the blockchain long enough, there's a problem.
Not necessarily, because if that Bitcoin has gone to an exchange, then when it comes on the other side, it's clean. You can't trace through exchanges in the same way that you cannot trace through mixers. But if that Bitcoin is like an old Bitcoin that has never been moved from that unhosted wallet, and it has touched any dark market, then you will know that. Yes, please. I think all of them, actually. I mean, we have just started scratching the surface in terms of financial crime around blockchain. I had an interesting conversation earlier about where this is going to. And I'm speaking with a lot of banks, and I'm speaking with a lot of exchanges. And what I see is different levels of risk appetite. So for example, banks may sometimes say that, yeah, I want to offer crypto, but I'm only going to allow my customers to transact with a specific list of entities that I have already done my due diligence and I feel comfortable with. So that's one tier. And then another tier is crypto exchanges, which will still allow customers to transact with or through unhosted wallets. And then there will be some participants in the intersection of the two that will enable funds to flow through from those exchanges to the banks. And these participants will probably be those exchanges or virtual asset service providers that are trusted by the banks and they fall into their whitelist. So that's, I think, probably the next step. And then after that, in 2 years' time, I don't know where this is going to go, to be honest. I'm really looking forward to find out myself. Yeah? This is a challenge for the industry. Not necessarily a solution. There are some that you can have a little bit of visibility, but you're not able to do the full tracing. Again, I think it comes down to risk appetite. So you see some participants that will allow their customers to transact in those currencies, some others will not. I think it would be great if we could do the traceability or, for example, trace through the Lightning Network. That's another big challenge. Or trace across chains. That's probably the holy grail in blockchain analytics. But I don't think that this should be the primary objective. I don't think these are the main problems we need to solve as an industry. Those problems can be resolved indirectly through policies, through procedures, through setting your risk appetite appropriately.